Hello and welcome to Tax Matters. The month of June is already packing its bags, and that means that if your accounting year is January to December, time is running out fast for you to fulfill your tax filing and payment obligations. We have explained this before, but let's go over it again. Limited liability companies with accounting year end of December 31st, 2020 have a few more days to file their company's income tax returns and pay, because these are due at the end of June. This is the way it goes. Companies are free to choose their 12 months accounting year. Could be August to July of the following year. Could be April to March, or the most common, January to December. The choice is yours, except for banks that are obliged by law to use January to December. If you have chosen January to December, then you have 6 months after your accounting year ends to file returns and pay. That means June 30 of the following year, and that's a few days away. Today's episode of Tax Matters is going to be a collector's item. We are going to be taking a close look at trending issues in the tax space in Nigeria. Of course, the biggest being the Finance Act 2020, which has an all-encompassing influence on almost all tax legislations in Nigeria. Also trending are the renewed emphasis on indirect taxes and on the use of technology in tax administration, and of course, taxation of the digital economy, or like somebody said, digitalizing the process of taxing economic activities. Our offering on this episode will revolve around presentations made by different experts at the capacity building retreat organized and hosted by the TAT for its commissioners. We'll begin with this backgrounder.
From time immemorial, taxation has been a problem for men. People always want to avoid paying taxes. Unfortunately, the more people earn or the richer they are, the more difficult it is to pay taxes. In our constitution too, under section 24, subsection F, it is a duty for every citizen to pay taxes. Our tax to GDP ratio in Nigeria is less than 7%. The average in developed societies is about 33%. So we have a long way to go. And this is a time when we need revenue from taxes more than ever before. People do not ordinarily want to pay taxes, and they will look for ways after tax planning to even evade.
Mr. Matthew Bojubola is the Coordinating Director, Special Tax Operations Group at the FRS. He spoke on emerging issues in transfer pricing. He began with this background.
There's always a question when we talk about taxation. And I will illustrate it by an experience I had some years ago, maybe about 20 years ago or thereabouts on this job. I led a team of audits to a company, and after we finished the audits and presented our report, and the managing director of the company turned to the audit team and said, "Look, Mr. Bojubola, you and your team, you have done very well. Thank you very much. But you are saying that my company is owing this amount of money." I said, "Yes, sir." He said, "You know that the road that you traverse and get to my office, we fix it by ourselves." He said, "Do you know that the drainage, where the water floods the street, we did it ourselves? And this is how much tax I paid last year. This is how much I paid the year before. What have I seen from it? And now you are asking me to come and pay more." And so this is the issue of the traditional question of which comes first, the chicken and the egg. Which one comes first? Do we have good governance first, or do we have the resources for good governance first? It's a debate that none of us can win in, either party you belong to.
Every day, my people dey for work. Some dey do office work, Some get it them own business, so all of them want good road, constant power for better life. Whether now office work, oh yeah, pay your tax. Whether now your own business, oh pay your tax. If you want a better life, oh pay your tax. Now your civic responsibility, pay your tax. Better soup, now money cook am. Oh yes. Nothing goes for nothing, my brother. If you want potable water, security and hospital for make life jolly.
That's right. Good roads, good hospitals, portable water, adequate security all come from taxpayers' money. Play your part in making Nigeria great. Everybody, small scale, big companies, entrepreneurs, do the right thing. Pay your tax. This message is from the Federal Inland Revenue Service, FIRS.
That is from the archives, but it does resonate. Mr. Bojumbola continues. He spoke about ways and means in which persons and corporate bodies try to avoid or evade paying taxes.
Many taxpayers, particularly corporate taxpayers, have devised various means by which they will minimize the effective tax rate. And how do they do that? They do that in a number of ways. And the major way is transfer pricing. If you look at this picture, it provides a summary of the way multinational entities structure their business worldwide. You will see ACO is the ultimate parent company, and it could be anywhere. It could be in the US, could be in the UK, or in any of the capital-rich countries. It has an intermediate company, which is also a parent company. Let's call it BCO. BCO could be in any country. And then it will have a small partnership wherein BCO will be a partner, maybe a research, maybe a common project, somewhere. And then you have subsidiaries. The CCOs could be anywhere again in the world, wherein businesses are conducted. The businesses could be a business of manufacturing, could be of marketing, could be whatever be it. And on down the line. This is a typical structure you will find of a multinational. Now, how does transfer pricing come in all of this? It comes because you see these entities, they are also trading within themselves. Somebody manufactures this, gives it to this other one. Somebody produces this intangible, makes it available to this other person. Somebody is providing accounting services, is seated somewhere there for the group. Somebody is providing legal services, is another country where it is seated for the whole group. So you see them within themselves. They do a lot of transactions, and they fix the price they believe will best maximize the profit for the group. That's number one. Number two is that which will also minimize the effective tax rate for the whole group. When we talk about transfer pricing, what are the issues? One, we must understand that when two independent persons are transacting businesses between themselves, most often, every party is wanting the best for itself. And so transaction or negotiations are done with best self-interest. And an example I would love to give is, if I'm walking on the street and I'm thirsty and I want to buy a bottle of water, I don't know the seller of the water doesn't know me. I will want to buy the bottle of water at the least price possible. And the seller wants to sell at the highest price possible so that he could maximize his profit. So all of us are defending our self-interest. And whatever price we agree on, then you can take that price as being driven by purely self-interest. But assuming I am thirsty and my wife sells bottled water, and I enter a shop and I say, darling, I'm thirsty. Most often, or most probably, I will have even finished drinking the water before I ask how much do you sell it. That is if at all I'm going to pay. Because I can say, look, after I pay your dowry. So I have paid in advance. Isn't it? So at that instance, the price the two of us will agree. I can't beat my chest that I have agreed that price in my self-interest, or that she has agreed to that price in her self-interest. Either one of us will give in. Either I will say, hey, this woman, she may lock me out of the room tonight. So if she's asking for 100 naira, you better pay now. Or whatever consideration. Now, so when two independent persons are dealing together and they are arranging prices, the prices are likely to be at arm's length because everyone is defending his self-interest. But where the parties are related or connected, you cannot beat your chest. And I can also tell you in business world, it is hardly that you will find that the prices will be at arm's length.
At this point, we bring in Barrister Emmanuel Eze, also of the FRS. How are tax authorities all over the world tackling transfer pricing? Barrister Eze actually spoke before Mr. Bojumbola at the same event, and he spoke on base erosion and profit shifting.
In the realm of tax avoidance, especially as related to multinational enterprises, they have large planning opportunities, options, which I put in baskets and refer to as base erosion and profit shifting schemes. These schemes enables multinational to use their nature and their structure as multinational to erode based on developing country like Nigeria, minimize their taxes, and in some instances avoid taxes completely. BEPS refer to tax planning strategies that allow multinationals to take advantage of gaps and mismatches in international and domestic tax laws to reduce or shift profit from high tax jurisdictions like Nigeria to low tax jurisdictions like Bermuda, so as to decrease their overall tax burden. The loopholes or mismatches are exhibited by the advance in technology, innovation, digitization, and general increase in the ability of corporations to do business across border or in multiple jurisdictions. The individuals and corporations involved in cross-border transactions and businesses, they take advantages of those loopholes, using them in drawing aggressive tax schemes, which enables them to avoid taxes and thereby minimizing the fiscal take of the government. We have these two instances of BEPS. Number one is thin capitalization. A foreign company desirous of doing business in Nigeria decides to fund its subsidiary with 90% debt and 10% equity. This is a classical case of thin capitalization. It's loading the local subsidiary with debt because of the preferential treatment that is given to interest as compared to dividend which flows from equity. And by so doing, the local subsidiary for the foreseeable future, its profit will be streamed to Bermuda or to Panama, wherever, where it is subject to little or no tax at all. The second instance is on treaty shopping. Nigeria do not have tax treaty with United States, but most United States-based enterprises, they do business in Nigeria and routing such businesses through Netherlands because we have tax treaty with Netherlands. They do the scheming using the tax treaty shopping option, which they could do because there's a loophole in the existing international framework today that enables them to do that. Countries around the world have made implementation of anti-BEPS measures a key priority In 2013, the OECD and G20 countries working together adopted a 15-point action plan, and over 135 countries and jurisdictions, including Nigeria, have joined the inclusive framework. Then country-by-country reporting is a big one because it speaks to a lot of changes. The Action 13 report, it contains revised standards for transfer pricing documentation and a template for country-by-country reporting for income taxes paid and certain measures of economic activities. I will quickly talk about CRS. CRS, you had some time ago when it was wrongfully reported that FRS is asking for details of your bank account. That's not true. The true situation is that we are implementing country-by-country report as part of our drive for transparency. We are implementing common reporting standard. And the standard entails that Nigeria as a country should be able to get financial information, bank information of foreigners who have such accounts in Nigeria and use a common pool to report it to their country of residence. Why other countries, foreign countries, could get the financial account information from the bank and other financial institutions in their country of Nigerian residents.
We return to Mr. Bojumbola.
Why is transfer pricing so important that the rule keeps changing? It's because the business life, the business environment is ever changing. And because the business are changing, there is also pressure on tax authorities all over the world to say, how do we catch this? Particularly the existence of investment centers. We no longer call them tax haven. We now call them investment centers. The existence of investment centers across the world where people pay little or no taxes. And entities are finding a place to put money. Before Trump came up with the 2017 tax reform in the US, Google had billions of dollars stuck in Ireland, which he couldn't move to the US because that was money that Google had handed all over the world without paying taxes. And if they brought it into the US, they would pay tax. And then so in 2017, when Trump came up with the tax reform in the IRS, Google agreed to pay about $40 billion in taxes to the US to bring those money to the US. I mean, there was 1 year that Coca-Cola handed about $20 billion as royalty. That was more than the total budget of Nigeria. I mean, that's just one income item for Coca-Cola. Was more than the entire budget of Nigeria. Now, don't talk about other entities that are even bigger than Coca-Cola. Now, the next big thing that happened after BEPS was the taxation of the digitalized economy. What do we have? Today, we have, I don't know how many times we have mentioned Zoom in this room today alone. And you can be sure that is how Zoom is being mentioned all over the world. But the question is, where is the office of Zoom in Nigeria? It doesn't have an office in Nigeria. And I can tell you in the whole of Africa, Zoom doesn't have an office. The question then is, should Zoom not be taxable in Nigeria? So, I can hear some saying yes. But then who do you tax? Where is his office? It doesn't have a representative in Nigeria. Zoom is in the air. Now, up till now, the taxing rule is based on physical presence. If you go and look at our PITA, go and look at our SITA, go and look at our PPTA, is when we can see you that we can tax you. That is the rule. And this is the basis on which all our treaties, our tax treaties are based. When you look at Article number 4, which talks about tax residence, or Article number 5 that speaks about permanent establishment, they are all based on physical presence.
We are sure you have been having an educative and informative time on this program. taxation has become more than ever before an international issue connecting countries across the globe. In spite of this, domestic laws are required to tackle the issues that crop up. The enactment of the Finance Act 2019 and that of 2020 in Nigeria are steps in this direction.
Nigeria was losing a lot of revenue because a lot of our tax laws were so outmoded that they were not fitted for the sophistication we see in contemporary commercial arrangements. So take the taxation of companies that operate in the digital space, for example. Up until the enactment of the Finance Act 2020, if you wanted to know whether a company, a non-resident company, was liable to tax in Nigeria, you had to go to Section 13.2. And those provisions relate only to physical presence, where a non-resident company is carrying on business in Nigeria and has some kind of physical presence.
Before proceeding, Barrister Ikwazum flipped back to talk about the Finance Act 2019.
What the 2019 Finance Act did was to introduce two additional circumstances. The first is the one that targets companies that provide digital services in Nigeria. So, going by this amendment, if a non-resident company is providing digital services to anyone who is resident in Nigeria, that non-resident company will be liable to pay tax in Nigeria on any income attributable to that activity, provided that that non-resident company has what is called a significant economic presence in Nigeria, SEP. So it would not matter that that company has not any presence in Nigeria. None of the employees of that company has set foot on Nigerian soil. All of that will be relevant. Once it is determined that that company has a significant economic presence in Nigeria, there will be tax liability. Now, the Act did not define what a SEP is. The authority to make that clarification was donated to the minister. The minister subsequently issued an order, the Significant Economic Presence Order. That order says that if you're a company, a non-resident company playing in the digital space, if you earn income of 25 million or more in any accounting period, then you will be deemed to have significant economic presence. So what that means is that companies like Google, companies like Facebook, companies like, all the digital companies that provide services that are enjoyed in Nigeria will now come into the Nigerian tax net by reason of this amendment. Now, the second circumstance that was introduced relates to non-resident companies that provide technical, professional, consultancy services in Nigeria. In the past, before these amendments were made, if someone who is not resident in Nigeria provides technical services or professional services to a Nigerian recipient wholly outside Nigeria, whatever income that person derives from providing those services will not be taxable. Now, that position has changed, because once such a provider is deemed to have a significant economic presence in Nigeria, there will be tax liability. Although the law says that for a non-resident provider of the services, the withholding tax that's deducted will be the final tax.
We pride ourselves on this program as the home for information and education on taxation. We do hope that once again on this episode we have lived up to billing. Let's roll again next week on this same station, same day of the week, same time of the day. Bye for now.